Good day, everyone. Thank you for joining me for the UPotential webinar called Not So Well-Known RSP Strategies. I just wanted to make everyone aware that the webinar is being recorded. So if there's anything that's unclear now that you need maybe to refresh your knowledge about, or something that you'd like to share with a friend or a spouse, it will be available for replay on the UPotential website. Just give us a day or two for that. And also, there will be an opportunity for some questions towards the end. So please feel free to use your questions tool to write out a question for me. And if I can, I most certainly will address it later in the webinar. Okay. So by way of introduction, again, for those of you who don't know me, my name is Monique Madan, and I'm a chartered financial planner and financial management advisor and a chartered financial divorce specialist. And although I've been doing this for quite some time, I've been in personal finance for almost 20 years, I kind of came to financial planning in about a roundabout way, not sort of your typical um, Bachelor of Commerce kind of thing. My undergraduate degree is in fact in neuropsychopharmacology, which is really about the drug effects on the brain. But I turned into personal finance early in my career. So it's been said to me that, my blend of sort of analysis and empathy kind of guides clients towards strategies that'll help them attain their goals, but perhaps more importantly, being someone who's on their side in case of turbulent times. And of course, when there are turbulent times, for instance, like 2020, other issues may take priority. So as a fee-for-service planner, I have the luxury of focusing exclusively on the client's needs because I don't sell anything, which is a nice specialty to have. Now, since turning to finance, I have had quite a broad range of clients that I've worked with, from high net worth clients to those who are financially vulnerable, and pretty much, every conceivable situation in between. I would say if you wanted to know who can best benefit from working with me, it would probably be people who are facing difficult decisions and have to, need a third party to kind of give them an idea of how to optimize their financial situations, both now and into the future. Now, professionally speaking, I'm the head of financial life strategies for UPotential and ETF Capital Management. Now, UPotential is the fee-for-service financial planning firm under an umbrella group called Q Wealth, and it offers unbiased advice and strategy to Canadians. This exact same service is offered to the clients of ETF Capital Management, but at no cost to them because it's part of their suite of client services. But I want to assure you that the advice is the same, and my focus is always on financial strategies that my clients need, including retirement planning, tax planning, and things of that nature. Specifically today, we're going to focus on RSP strategies. And I think most people are comfortable with the idea of an RSP and its theory. A savings habit early in life is good, but there are a lot of strategies that can make this very good habit even more effective. Now, I'd like to start by making sure that everybody's on the same page. So let's go through the basics. An RSP is the advent of the Income Tax Act, meaning that it's a way for the government to incentivize us to take control of funding our own retirements. You can imagine in generations past, it was less necessary for us to save through our working years because more people had workplace pensions, we weren't living as long, and even if we needed a little bit of a top up on our workplace pensions, there was the Canada Pension Plan and ultimately old age security. Now, fast forward to today, and workplace pensions are scarce, really only available to people with who are working for very, very large corporations, governments, or educational institutions. So we need to plan for ourselves. From a tax perspective, RSP contributions allow you to reduce your taxable income in the present day. And the money that you withdraw from the RSP, very often in the form of its sister, the RIF, is taxable when you withdraw it. So in a perfect scenario, the RSP contribution is most effective if your projected tax burden in retirement is lower than you are facing today. In other words, this blends, a good tax refund for you in the present day with lower taxation down the line. Now, contributions are limited to 18% of the previous year's earned income, plus any room you haven't used before. Now, earned income is an interesting concept which a lot of people ask about. You only earn RSP contribution room from employment income, rental income, spousal support that you receive, and other things. There's a larger list on the Canada Revenue Agency website if you want to know particulars. But most importantly, contribution room is not earned on investment income, which can be particularly important for those of you who might be self-employed. If you're paying yourself exclusively in corporate dividends, then you're not accruing RSP contribution room. And finally, in our cursory discussion of the basics, so we can get to the more juicy topics, the Income Tax Act allows us to apply contributions made in the first 60 days of the calendar year to either the previous year's taxable income or the current year's taxable income, and you can choose whichever is best for you. Now, this year's deadline is March 1st. Often, if there's a leap year, it would be February 29th. But if you make your contribution or you have made your contribution anytime from January 1st rather to March 1st, and you expect your taxable income for 2020 to be higher, you might want to report it back on your 2020 tax return. Now, I could literally talk about RSPs all day, and I often do, but today I want to spend some time on strategies that clients have been asking me about regularly. I'd like to talk about how to optimize the tax deduction to get the best refund possible, which might be especially helpful when reporting your taxable income for 2020. I want to revisit the spousal RSPs, which were, all the rage some years ago, but perhaps have less relevance in most cases now. And finally, I'd like to address a question that I get often, which is whether the prevailing low interest rates make borrowing for RSP contributions more attractive. So let's start with the first topic, which is timing your tax deduction. Conventional wisdom tells us that RSP contributions should be started as soon as someone earns the room and consistently throughout your life at the highest level possible. Now, if we were to focus on early years, many of us started in our careers, in our late teens or early 20s, and applying your RSP contribution against the income you made in those years probably did not give you a terrific tax refund. There are good reasons to start saving as soon as you earn the room, specifically because it's a great habit to have, and secondly, because it could certainly help a young person to make a down payment on a home through their home buyer's plan, or to fund their own education through the lifetime learning plan. But from a tax perspective, the deduction probably is not particularly juicy in these years. And the reason is that the rate at which your RSP contribution is refunded to you is based on the rate of tax that you paid in the first place. And early in our careers, before we've established ourselves and proven ourselves, chances are the refund is less than optimal. So for the vast majority of Canadians, healthy refunds won't happen until a few years of work. However, it still makes sense to make the contribution so that you could take advantage of tax-deferred compounding of investment income. So how do you reconcile this discrepancy? Well, it's little known that you can make an RSP contribution in one particular year, but apply the deduction against your income in another year. In other words, you make the contribution to the RSP, you receive the slip from your financial institution, you report the slip on the tax return, but you don't actually deduct it against that year's income. Instead, you claim it against your income a year or two or several years later. This is a particularly interesting point in this year because in 2020, few people were untouched by the pandemic. So it's possible that you might have had lower earnings in 2020 than you're accustomed to. At the same time, we had fewer opportunities to spend. We couldn't travel, we couldn't entertain, we couldn't eat out. So this is kind of the perfect storm of potentially lower income temporarily, but having discretionary cash in your bank account with which to make the contribution. So it might be very worthwhile to make the contribution in this year, but not claim it against your 2020 income, especially if you anticipate your income rebounding in 2021. Now, before we go any further, I just want to clarify one thing. Unfortunately, the vernacular about RSP contributions and unused contributions is very poor. So I want to make this crystal clear. When we talk about unused contributions, most people immediately think of what you see on the screen, which is an example of a notice of assessment that shows you what your RSP contribution room is like for that year. It basically shows you what your limit was the previous year, what new room you earned in the current year, and any adjustments for things like contributions that you made or participation in a pension plan. So this leaves you here with your 20, in this case, it would be the 2020 RSP deduction limit. But if you don't deduct the contribution in that year, it will appear on this line as an unused contribution, or literally a contribution that has not yet been used to reduce your taxable income, but you still can't contribute that money. Instead, the very last line, available contribution, will tell you what your continuing contribution room is for the following years. Now, this is pretty interesting because, you know, if you think that many people don't look at their notices of assessment, even fewer look at this particular detail. So this is one of the things that I look at very closely when I'm reviewing for my client meetings. And I'm often the one to tell people that they're either carrying unused contributions that should be applied, or worse yet, that they may have negative contribution room, meaning that they've over contributed. Now, over contributing is not in and of itself a bad thing, but if the over contribution exceeds $2,000, that's the leeway. You can make a mistake, but only up to $2,000. Anything exceeding $2,000 in over contributions will attract interest and penalties. Now back to our example of, let's say, contributions made by a young person early in their career. It's not uncommon for your taxable income to be dramatically lower than it will be a few years later. And even, like I said, for those seasoned in our careers, 2020 could be a year that's artificially low in terms of taxable income. So this might be the perfect year for you to make the contribution, but then strategically claim the deduction, especially if your income has already rebounded from the pandemic. So in this particular case, if you look on the left-hand side, these are the tax rates for, this is federal and marginal, these are the federal marginal tax rates rather. In 2020 is on the left-hand side, 2021 is on the right-hand side. So for example, if let's say you had 6 months where your income was less than normal and you find yourself, let's say, in this tax bracket in 2020, but then everything has normalized, you might be in this tax bracket in 2021. Imagine then that you make an RSP contribution in 2020, getting your money refunded to you at 15%, when if you simply waited a few months, that same contribution could attract a deduction or a refund at 26%. So this is the kind of idea that I'd like you to consider, especially for the present year. Now you might ask, why not just sit on the money and contribute it in 2021? Well, because again, contributions made early have the benefit of compounding in a tax deferred environment. Same idea as the young person making the contribution early in life. Those contributions will have an enormous benefit over the many, many years that they sit in an RSP. But again, is it the best time to apply the deduction? And my argument is to make the contribution as early as you can afford it, but then claim the deduction in whatever way is most useful for you. Okay, so let's move on then, and we're going to talk a little bit about spousal RSPs. So it's always interesting to me how government policies evolve over time, and this is certainly something that has affected the spousal RSP quite dramatically. So starting again with the basics, a spousal RSP used to be incredibly popular when couples found themselves in a particular situation where one spouse, for example, was earning a significant income and accumulating, a good amount of RSP contribution room, but the spouse perhaps earned less and had less contribution room. This pattern then would translate into higher taxation for the higher income spouse during their working years that would continue into their retirement because their RSP would be better funded than the lower income spouse. Instead, the idea is with the spousal RSP that the higher income spouse can make the contribution and apply the deduction against his or her income if that's the most favorable way to do so. In the end, the lower income earner's tax rate is used on the withdrawal end when the money's taxed as it's removed, again, in the most favorable way possible. So, et voila, a tax strategy is born. Now, in more recent years, income splitting in retirement has allowed Canadians to move away from having to accumulate assets in the hands of the lower income earning spouse. What this does is it allows you to not so much have to worry about equalizing two accounts. You don't have to, let's say, make sure that both of your accounts have, a similar balance in the RSP. Instead, what it allows is CPP income, employer-sponsored pension income, and RIF withdrawals that can be split for tax purposes. In fact, except for CPP sharing, which is literally done at source, so that, let's say, whatever proportions of your CPP are being split between the spouses stays consistent from year to year, everything else, employer-sponsored pensions and RIF withdrawals, can simply be reported for tax purposes in whatever way is most advantageous for the couple. So for example, you could report more in the hands of the lower income earning spouse if his or her taxable income that year was low. If, on the other hand, the lower income spouse sold, let's say, a stock and made a decent capital gain, well, you could adjust the amount that you split the following year because the lower income spouse will have that sort of isolated, unusual tax event. So this is incredibly flexible and has made us wonder perhaps if the spousal RSP is even required any longer. Well, in some cases, yes, spousal RSPs are still worthwhile, specifically because the amount that the spouse can report on his or her tax tax return, if you're income splitting, you can only split half of the amount. Whereas if you have a spousal RSP, your spouse is taxed on 100% of the withdrawals. So you can imagine in the cases of spouses with, let's say, little other income, this could be very, very valuable. Also, if your spouse is younger, you can contribute to a spousal RSP even after you're prohibited from contributing to your own. So, for example, as many of you might know, you can't make contributions to an RSP, to your own RSP, after the age of 71. At age 71, by the end of that year, you have to convert your RSP to a RIF, and minimum RIF withdrawals then become, required the following year. But if the higher income earner is still working and earning earned income, he or she can contribute to a spousal RSP until the younger spouse turns age 71. At that time, the younger spouse will have to convert his or her RSP to a RIF in the similar manner. So you can imagine for those isolated years between the higher income spouse working and also withdrawing from his or her RIF, to the lower spouse's age 71, when he or she can no longer have an RSP, those intervening years, the higher income spouse can still make contributions. So this is a very little used opportunity, which I would certainly ask you to think about. Similarly, and this is maybe not the most pleasant of circumstances, but in the year of death, a deceased taxpayer can't make an RSP contribution. And if anyone has had the misfortune of having to deal with someone's taxes on their terminal return, you'll know that this can be a very, very expensive year. And they could certainly use an RSP contribution if they're young enough to do so. So the deceased representative, the executor, you might be referring to this person, can make a spousal RSP contribution on behalf of the deceased in order to use carry forward contribution room and control the deceased's terminal taxes owing. This can be incredibly effective at controlling the amount of tax that's paid, as well as assisting with the transfer of assets between spouses. Now, in order to prevent some high income earners from contributing to spousal RSPs and then having the younger spouse or the lower income spouse withdraw it right away, the Canada Revenue Agency has imposed a few cautionary notes. Specifically, if you've made a contribution to a spousal RSP, the spouse should not withdraw that money for the first 3 years. Any withdrawals made literally, I think it's 24 months and 1 day, but literally 3 calendar years. Any withdrawals made during that period are attributed back for tax purposes to the contributor. So it actually goes exactly against what the strategy is supposed to be doing. And these are called the spousal attribution rules. So you do want to be careful about that. As an extension of this, if, let's say, later in life, an individual has a spousal RSP and his or her own RSP, it can be very tempting to consolidate the two, especially because it makes better investment decisions. You want to be very, very careful about this because when you commingle a spousal RSP and a personal RSP, the end result has to still respect the spousal attribution rules. So if you can imagine a spousal RSP meeting with or commingling with a regular RSP, the whole new account will be treated like a spousal RSP. And finally, let's look into what this year looks like in terms of, great opportunities to make contributions, but some people also saying to me, well, we're also looking at an era of very low borrowing rates. How does this affect my RSP strategy? Well, I won't lie. I don't really love the idea of borrowing for RSP contributions. And I'll be perfectly honest, it has to do with the fact that I don't really have a great tolerance for leveraged investing. But I do appreciate that there's lots of people who do, so I have gone about investigating how this can be done relatively safely. So as clients are looking at leveraged investing due to the low interest rates, for the most part, they're looking at what is the cost of my borrowing, in other words, the interest rate relative to the return on investment that I can earn. So that would be true of borrowing to invest, let's say, in a non-registered account. But borrowing to invest in an RSP doesn't need to be evaluated in the same way because for the most part, the tax refund that you would get eclipses the interest rate that you would pay. And obviously, of course, I appreciate that that's why it would be such an attractive opportunity. Now, the concern, of course, is that when you borrow to fund an RSP contribution is that oftentimes the amount that's borrowed adds to existing debt. It isn't, the refund ends up not being large enough to repay it in full. So you end up simply with more debt after all is said and done. But what if you could calculate the exact amount that you could borrow and repay with your refund? So in comes John Natali of Manulife, who has put together a formula to help us with that exact calculation. So assume for a minute that you have, let's say, more RSP contribution room than you have available cash. The formula then calculates the exact amount that you can borrow to increase your contribution while ensuring that the refund is enough to repay it. Okay? So this is anticipating what your future refund will be and designing your loan accordingly. So let's use an example. If let's say I had $40,000 in contribution room and I'm typically in a 40% marginal tax rate, but I only have $10,000 on hand. Now, the Monique way of doing it would typically be to make a contribution of $10,000. But again, I appreciate there are people with higher risk tolerances than me. If I wanted to make a larger contribution, the formula that I showed you says, if I were to borrow exactly $6,667, in other words, make a total contribution of $16,667, my refund should be $6,667, which would be exactly enough to repay the loan. Okay, so that's a really sweet idea. Now, for T4 employees with no other income who can fairly reliably assume that their RSP contribution will produce a refund, I would totally support you if you wanted to use that strategy. But for clients who have more than one source of income, so in other words, perhaps you had the CERB for this year, perhaps you have a side business, you're self-employed and you have some adjustments that you make to your income year to year. In those cases, it's much harder to anticipate whether a higher RSP contribution will in fact produce a refund or simply reduce the amount owing. So that's where you want to be very, very careful. So for those of you who've worked with me in the past or heard me speak before, you'll know that I have a little love affair with a form called the T1213. The T1213 informs your payroll department of tax planning that you're already doing or that you've committed to so that they can anticipate your taxes owing and adjust your source deductions accordingly. So let's look at something like what I've shown you here. Imagine we're going to focus on the column that's called normal in teal. So imagine that I'm earning $100,000 and my biweekly income, so over the 26 pay periods, my biweekly income is 3846. In a regular year, if I were to use an average tax rate of 27%, my payroll department would withhold $1,038, and my biweekly earnings after tax, let's say I'm living in Alberta, would be $2,807. That's what would hit my bank account. If I file a T1213 and inform my payroll department, let's say, that I would like to make a $5,000 contribution that year, and I commit to it, my annual earnings haven't changed, my biweekly income hasn't changed, but the taxes withheld, my payroll department will actually withhold taxes owing by someone earning $95,000 a year. So it's at the source. They will deduct less because you are going to be contributing the $5,000. What that results in is a slightly higher take-home earnings, making it easier for you to make the RSP contribution. Now remember, this is very important, two things. Firstly, if you're going to file a T1213, you have to follow through with the contribution or you will find yourself owing tax at the end of the year. All this strategy does is it advances you the tax refund that you would normally get from the contribution when you report your taxes in April. Okay, it's giving it to you on a biweekly basis instead of in one lump sum when you file your tax return. Now, this works the same way for people who are paying spousal support, and it can be, a fair bit of a responsibility. So let's say we go through a situation where someone is earning $100,000 as before, but is mandated to pay $25,000 a year in spousal support. Okay, same idea on the left-hand side. The annual earnings are $100,000, biweekly income is $38.46, the taxes withheld $10.38, biweekly earnings $28.07, but now my client has to pay 1/26th of the $25,000 spousal support amount that they're mandated, leaving only $1,845 for their own needs. Look what happens though on the right-hand side if you inform your payroll department of your divorce decree or your separation agreement. Now, annual earnings are the same, biweekly income is the same, a significantly smaller amount is paid in tax, only $779, making your biweekly earnings on an after-tax basis $3,067, meaning that you have $2,105 for your own needs. Now, this is a very, very powerful display that I use when I'm working with divorcing couples to help the payer understand what their obligations will be going forward and how to budget afterwards. It may not seem like a tremendous difference, but those few $100s can certainly make a big difference when someone is trying to reestablish themselves after, a very disruptive thing like a divorce. Now, in summary, before I take some questions, certainly you want to make an RSP contribution as early as you can, but I do ask that you consider your current tax burden and perhaps the tax burden over the next couple of years if you can anticipate that, and claim the deduction strategically. Secondly, spousal RSPs are not as useful as they once were, but they still have merit in some cases. And please use caution when you're considering borrowing for an RSP contribution. And if you have predictable income, in other words, income from only one source that's quite regular, then you could use the Manulife formula that I shared with you before to figure out how much you can borrow while at the same time ensuring that your refund will cover the loan. So I'm going to take a look at what questions might have come in. and see if I can address any. Okay, so someone is asking, so what happens if you defer claiming your RSP contribution and then you want to buy a house? In other words, would this, I gather this person is asking whether it would interfere with the home buyer's plan. So the answer is yes, you would be able to withdraw the money, but the whole idea of withdrawing the money for the home buyer's plan purchase is that you will have recognized an RSP contribution deduction at some point. So what I would say to you is you don't necessarily want to, you would definitely carry it forward and use it in the most strategic way possible. And it should not interfere with using the home buyer's plan. But at the same time, it won't be as effective as it could be if you made the contribution, recognized the tax deduction, and had your refund in hand to make an even larger home buyer's plan contribution, or sorry, withdrawal. So I would ask you just to be very careful about that. So this particular question goes on and says, this is for our child. So I'm not sure I quite understand what that question is drawing at. Let me see. Yeah, you know what? I'll ask the writer of the question either to give me more details or to contact me privately, as I don't really understand the question. I'll wait to see if there are any others. Okay. Okay, looks like that's it. So let me just give you then a sneak preview of our upcoming webinar then. It's going to be talking about taxes on Tuesday, March 23rd. So you will get an invitation to join us for that webinar as well. And in the meantime, I just want to thank you for all of your time and attention today and remind you that a recorded version of this seminar will be available soon. Certainly, if I can be of any service, please don't hesitate to call me. All my contact information appears in front of you, and it would be my pleasure to help in any way that I can. Thank you so much for joining me today.